Imagine you and a business partner have been accused of financial fraud. The authorities separate you, offering each of you a choice. If you both remain silent, you each serve only 1 year in prison. If one of you betrays the other while the other stays silent, the betrayer walks free while the other serves 5 years. But if you both betray each other, you each serve 3 years. You can't communicate. You don't know what the other person will do. What choice do you make? This is the prisoner's dilemma, one of the most famous theories in game theory and economics. It's not just a hypothetical scenario, it plays out every day in business, finance, and global markets. From corporate competition to stock market behavior, from government policies to international trade, the prisoner's dilemma reveals a fundamental truth. Trust, or the lack of it, drives economic decisions. But here's the problem. Most economic systems aren't built on trust, they're built on self-interest. Companies, nations, and individuals act to maximize their own gains, often at the expense of others. And when trust breaks down, markets collapse, businesses fail, and economies spiral into crisis. So how does the prisoner's dilemma explain real-world economics? And why does it reveal so much about financial markets, negotiations, and global wealth distribution? To understand, we need to break down how this theory plays out in real economic decisions. The prisoner's dilemma in business and market competition. The prisoner's dilemma isn't just about criminals, it's the foundation of corporate strategy. Take two competing companies, Coca-Cola and Pepsi. Both spend billions on advertising, product development, and distribution. But here's the question. Would they be better off if they both agreed to stop spending so much on marketing? If they both reduced their ad budgets, they'd save billions in costs and still maintain their market share. But if one company cuts spending while the other continues, the competitor wins the market. So what do? They both keep spending aggressively because neither one can trust the other to hold back. The result? An economic arms race. This same logic applies to price wars, labor negotiations, and even trade agreements between nations. If companies and countries could trust each other, they could cooperate, reduce risk, and maximize long-term prosperity. But in most cases, fear of betrayal forces them into self-destructive competition. And nowhere is this clearer than in financial markets. The prisoner's dilemma and stock market crashes. Stock market behavior is one of the most extreme examples of the prisoner's dilemma. Consider a scenario where investors see early signs of an economic downturn. If they trust the market and hold their stocks, prices stabilize and the economy recovers. But if some investors start selling their assets out of fear, others panic and sell too. Before long, everyone is selling, causing a market crash. Even if some investors know the economy will recover, they don't want to be the last ones holding stocks while everyone else cashes out. So instead of making rational long-term decisions, fear and self-interest create a chain reaction. This is exactly what happened in the 2008 financial crisis. Banks knew that reckless lending and subprime mortgages were risky. But they also knew that if they didn't offer those loans, their competitors would, and they'd lose market share. The result? A self-destructive cycle that collapsed the housing market and triggered a global recession. This raises a powerful question. If trust and cooperation lead to better economic outcomes, why do we keep falling into these destructive cycles? We've seen how the prisoner's dilemma plays out in business, financial markets, and corporate competition. It explains why companies engage in price wars, why investors panic sell during crashes, and why even the biggest financial institutions take excessive risks. But here's the bigger question. Can we ever escape the cycle? Governments, policymakers, and economists have spent decades trying to solve this problem. They know that when trust collapses, markets crash, economies slow down, and financial instability spreads. So they've developed laws, regulations, and incentives designed to force cooperation and prevent economic self-destruction. But do these solutions actually work? Or do they sometimes make the problem even worse? To understand, we need to look at how governments intervene in the economy, and why their decisions often trigger new versions of the prisoner's dilemma. Government intervention. Can policies solve the trust problem? Governments and central banks have several tools to prevent financial crises and promote stability. One of the biggest? Regulation. For example, after the 2008 financial crisis, new banking regulations were put in place to prevent reckless lending. The idea was simple. If all banks are forced to follow stricter rules, they won't engage in the kind of risky behavior that led to the collapse. But here's the problem. If a financial system is too regulated, it can slow down economic growth. Banks become too cautious, businesses have less access to credit, and innovation stalls because companies can't take big risks. And the moment regulations loosen up again, the prisoner's dilemma returns. Banks, investors, and corporations once again compete for short-term gains, knowing that if they don't take advantage, their competitors will. The result? A system that never fully escapes the cycle, just shifts between overregulation and financial bubbles. But this dilemma isn't just about financial markets. It plays out on a global scale. Because when it comes to trade, taxation, and international finance, countries face the same problem: cooperate for mutual benefit or compete at the expense of stability. The prisoner's dilemma in global trade and economic policies, one of the best examples of the prisoner's dilemma in economics. International trade wars. Countries benefit the most when they cooperate, lowering trade barriers, reducing tariffs, and allowing free market competition. But there's always an incentive to cheat. For example, the US and China both benefit from trade. China sells manufactured goods to the US at low prices, while the US provides advanced technology and financial services. But over time, both sides fear they're being taken advantage of. The US worries that China manipulates its currency and subsidizes industries to dominate global markets. China worries that the US controls the financial system to maintain economic superiority. So what happens? Each country imposes tariffs and trade restrictions, trying to weaken the other. But instead of benefiting, both sides lose. 1. Prices rise for consumers. 2. Companies lose market access. 3. Global trade slows, hurting economic growth. And yet neither side wants to stop, because if they do, the other country might gain an economic advantage. It's the prisoner's dilemma on a massive scale. And this same logic applies to corporate tax policies, financial sanctions, and even currency manipulation. Every country wants to protect its own economy, but in doing so, they often create instability that makes everyone worse off. Breaking the cycle, can trust be built in economic systems? So is there a way to break the prisoner's dilemma in economics? In theory, yes. Economists and policymakers have tried several strategies to encourage cooperation, including 1. Stronger international agreements, trade deals that prevent countries from breaking the rules. 2. Financial oversight, regulations that limit risky behavior before it spreads through markets. 3. Monetary coordination, central banks working together to stabilize exchange rates and avoid currency wars. But here's the harsh reality. Even with these agreements in place, the incentive to break the rules never fully disappears. Nations, businesses, and investors will always have the temptation to act in self-interest, especially if they believe others are doing the same. And that's why economic cycles of booms, busts, trade wars, and financial crises keep repeating. Because at the core of global finance, trust is fragile. And when trust collapses, so does the economy. The role of trust in the future of economics. The prisoner's dilemma isn't just a game theory concept. It's a blueprint for understanding economic decisions at every level. From individual investors to global markets, from corporate strategy to international trade, trust, or the lack of it, dictates how financial systems operate. So what does this mean for the future? Will we continue to see financial cycles driven by fear, greed, and short-term incentives? Or can new systems, technologies, and policies build a financial world based on real trust and long-term cooperation? That's the question economists and policymakers will be trying to answer for decades to come. And whether you're an investor, a business owner, or just someone trying to navigate the financial world, understanding the prisoner's dilemma can help you make smarter decisions. Because in the end, economics isn't just about money. It's about trust, and trust is the most valuable currency of all. Like and subscribe for more deep dives into financial concepts, global markets, and economic strategies. Do you think trust can ever be built into financial systems? Or will self-interest always win? Let's discuss in the comments.